Whole life insurance is a cornerstone of the national insurance exam, and it is designed to provide permanent protection for the insured's entire lifetime as long as premiums are paid. One of the most critical aspects you need to understand for the exam is the concept of level premiums, which means the cost of the insurance stays the same from the day the policy is issued until the day the insured dies or the policy matures. On the exam, they often try to trick you by suggesting that premiums increase as the insured gets older, like they do in term insurance. But for whole life, the premium is mathematically leveled out to remain constant. Another defining feature is the guaranteed death benefit, which also remains level throughout the life of the policy. The exam frequently tests your knowledge of the cash value component, which is often referred to as a living benefit because the policy owner can access these funds while the insured is still alive. This cash value grows on a tax-deferred basis and is guaranteed by the insurance company to reach a specific amount by the time the policy matures. You should be prepared for questions regarding policy maturity, which traditionally occurs at age 100 or sometimes age 121, depending on the specific contract wording used in the question. When a policy matures or endows, the cash value exactly equals the death benefit, and the insurance company pays that amount out to the policy owner. A common trap on the exam involves the relationship between the cash value and the death benefit. So remember that as the cash value increases over time, the net amount at risk to the insurance company decreases. If you see a question about policy loans, remember that the cash value serves as collateral, and if a loan is not paid back before the insured dies, the outstanding balance plus interest will be subtracted from the death benefit paid to the beneficiary. You must also distinguish between non-forfeiture options and settlement options. Non-forfeiture options are the choices a policy owner has when they decide to stop paying premiums and want to protect the equity or cash value they have built up in the policy. These usually include cash surrender, reduced paid-up insurance, or extended term insurance. A great way to remember the three pillars of whole life is the phrase level premium, level death benefit, and living cash value. This means the costs stay the same, the payout stays the same, and you gain a savings account you can use while living. The exam will likely ask how the cash value is affected by premium payments, and you should know that in the early years of a whole life policy, the premiums are higher than the actual cost of insurance to fund the cash value reserve for later years when the cost of insurance exceeds the level premium. This front-loading is why whole life policies have higher initial premiums than term policies for the same amount of coverage. Watch out for questions asking about the guaranteed interest rate because whole life provides a fixed minimum growth rate, unlike variable life products, which carry market risk. If the question mentions a policy that endows at age 100 and has fixed payments and a guaranteed payout, you are looking at a classic straight whole life policy. It is also important to differentiate between straight life, where premiums are paid until age 100, and limited pay life, where premiums are compressed into a shorter period like 20 years or until age 65. Even in a limited pay policy, the coverage remains for the whole of life, and the cash value continues to grow after the premium paying period ends. On the exam, you might see a question about the tax treatment of cash values, and you must remember that while the growth is tax-deferred, the money is generally only taxed if the policy is surrendered and the amount received exceeds the total premiums paid into the contract. Another point of confusion is the difference between a policy loan and a withdrawal, and you should know that whole life typically uses loans, which must be repaid with interest, whereas universal life often allows for partial withdrawals. If you focus on the guarantees of the death benefit, the level nature of the premiums, and the inevitable endowment at age 100, you will be well prepared for any whole life questions on the national exam.